So guys, let's get started. I know that it's about 6 minutes past 3. We've got a lot to get through today. I don't want to run out of time, so let's start now. The first thing I wanted to do was to go back to the PowerPoints that we were looking at last week in class. And I know there was a lot of information to take in last week. There was quite a large topic that we were trying to get through. And what we were talking about last week was these concepts of risk and return. And I just wanted to quickly revise those concepts of risk and return that we were talking about last week, and talk about how we measure that for a single asset, and then briefly talk about a portfolio and what we'll do with the PowerPoints. I know we got up to slide 38 last week. What we're going to do is just to focus on what's really important after slide 38, because I noticed in this topic and the next topic, there's a huge amount of information. And if you're very interested in finance, it's an interesting read, but I'm really going to focus in on the parts of the PowerPoints that are the most important. So we might skip over some PowerPoints that I think they're not as important for you to know. If you're very interested in finance, you can go and look at them at home. You can ask me if you have any questions, but I'm just going to choose the PowerPoints that have the really important information that you need to know about risk and return, and in the next topic about the cost of capital. So we're just going to be quite selective today, and it's deliberate. I'm doing that because I can see that there's over 60 PowerPoints in each of these topics, and there's a lot of information that I would say is not essential for a financial manager to know, but it's interesting if that manager has an interest in finance. So we talked about risk and return last week. So risk refers to the probability that the actual return will differ from the expected return. That's what we mean by risk. What's the chance that the actual return you get is going to be different from the return you're expecting? The greater the probability, the higher the risk of the investment. And return refers to the financial compensation that you get from choosing to invest in that asset. So we talked about risk and return. And we talked about how we can measure this concept of return, the financial compensation. And we looked at measuring return as the total dollar return from investing in an asset. We also looked at the total percentage return. And I remember saying last week, in finance, we more commonly measure return as a percentage, as a rate of return. Do you remember how we measure risk? What do we calculate as a measure of risk? Standard deviation. So we looked at these statistical calculations. We looked at calculating what's called variance, and from the variance, we calculate the standard deviation. So the standard deviation is our measure of total risk for an asset. And we looked at calculating that standard deviation for a single asset. And we stopped just before the example that did the calculation for a portfolio last week. So we'll just revise the steps that we worked through. There was an example that we went through. There were shares in Emu, shares in Kiwi. We looked at other examples as well of calculating the variance and the standard deviation. And I remember saying before we finished last week that it would be really good to go and practice at home, practice the calculations just for a single asset. Because if you can get the calculation for a single asset, it's much easier to extend that to a portfolio of assets. So depending on whether we have historical data, if we're working with historical data and we've got actual returns, then we would calculate the historical average return. But if we're working with forecasts for the future, then we would calculate the expected return in the future. So it depends what kind of data we have, if it's historical or forward-looking, as to whether we call it an average return or we calculate the expected return from the asset. So first thing we did was we calculated the average historical return, or we calculated the expected return from the asset. The second step was calculating the difference. And it depends whether we're working with historical data or forecast data. We're either going to calculate the difference between the average and the actual return, or we're going to calculate the difference between the overall expected return and the expected return in each state. And once we get the difference, we square the difference. We add all of the squared differences together, but that's not the variance. The variance is actually the sum of all the squared differences divided by t minus 1 to get the variance. What's t? Yeah, the number of items, the number of observations, the number of pieces of data that you have is what we mean by t. So that gives you the variance. How do we find the standard deviation from the variance? Square root. So then the standard deviation is the square root of the variance. So we went through all of those steps last week. We looked at doing that for a single asset. There were some good examples in the PowerPoints of calculating the variance and the standard deviation that I wanted you just to go through again at home, just to be really comfortable with those calculations. So we looked at measuring return, total dollar return, total percentage return, and we looked at measuring risk. And our measure of risk is called standard deviation. Standard deviation is a measure of the total risk of an asset. The higher the standard deviation, the higher the risk of the asset. If the risk is higher, that means there's more variability or more volatility in the returns from the asset. We also talked about what's called a portfolio. What's a portfolio? A collection of assets, whatever different assets you've invested in, your collection of assets or your group of assets that you've chosen to invest in is your portfolio. So we focused on doing the calculations initially for a single asset, and then we started talking about a portfolio and how with a portfolio, it's possible to measure the expected return from a portfolio and the standard deviation of the portfolio. But we didn't do any calculations on standard deviation for a portfolio of assets. Now, the example that we stopped at in the PowerPoints last week, if you actually click on the Excel link, and I'll do that to show you, that example is really complex. There's lots of assets in the portfolio. And I think it's probably not the best example to start with when you're doing calculations for a portfolio. It's easier to look at examples that have, say, 2 or 3 assets, not 5 or 6. So I've decided that we're not going to go through all the detailed calculations in Excel because there's so many assets that it becomes quite confusing. But one thing that's important when you're looking at a portfolio, whether you're calculating the expected return or the standard deviation, it's important that you can calculate the weight of each asset in the portfolio. That's really important. So I'll give you a really simple example. Better to start with something simple. The one that's in the PowerPoints in Excel is quite complicated. So let's say our portfolio has 3 assets. So we've got 3 assets in our portfolio, and I'll tell you how much money we have invested in each asset. So let's say we've got $600 invested in shares in company A, $1,000 invested in shares in company B, and $400 invested in shares in company C. We need to determine the weight of each asset in the portfolio. What's the total value of the portfolio? $2,000. If we add them all together, the total value of all of these assets adds up to $2,000. So then the weight of shares in company A is equal to 600. That's what we've invested in company A, divided by the total value of our portfolio. So what percentage do we have invested in A? 30%. So company B, we've got $1,000 invested in B. The total value of the portfolio is $2,000. So what's the weight of our investment in B? 50% of our portfolio, half of our money is invested in shares in company B. So for C, we've got $400 invested in C. The total portfolio value is $2,000. So C must be 20%. So being able to calculate these weights is an important step when you do any calculations, whether it's expected return or standard deviation for a portfolio. It's really important just to look and see what's the total value of the portfolio and then what percentage does each asset make up of that total value of the portfolio. Are there any questions about this example here about calculating the weights? So that's normally the first thing I do if I'm looking at a piece of information about a portfolio. The very first thing I do, if I'm not told the weight of each asset in the portfolio, I calculate the weight of each asset. Because whether I'm measuring expected return or standard deviation, these weights will be relevant in those calculations. So what I'm going to do is go back to the PowerPoints where we were talking about risk and return and portfolios. And there's still some information from that topic that's important that we need to have a look at. In particular, we need to have a look at some of the slides in that topic that discuss risk. So we'll go back to the week 8 PowerPoints, and we got up to slide 38 is where we got up to. And then it goes on to give you an example of calculating expected return for a portfolio and the variance and standard deviation. But when you go into the Excel, you'll see, I suggest don't look at this example unless you're really confident with the calculations, because there's a lot of assets and it can get confusing. So I had a look at the calculations and I could see that there's 5 assets in the portfolio. So with 5 assets, we've got 5 weightings for each asset, and all the calculations became a lot more complicated. Plus, there's 3 different states that could happen in the economy. So what I'm saying is it's a complex example. If you don't feel confident, don't look at that example for the calculations. Just work through the calculations for a single asset. That's really important. And the other thing to work through was with the portfolio, we calculated the expected return. So calculating the expected return for a portfolio is not as difficult as going through the calculations in this spreadsheet here. So I want you to know how to calculate the expected return or the average return for a single asset. I also want you to be able to calculate the variance and standard deviation for a single asset, which we did last week. And for a portfolio of assets, I want you to be able to calculate the expected return from the portfolio. So we did all of that last week. We looked at all of those concepts last week. That's what you need to focus on. So if I give you some practice questions on this topic, I'm going to focus on those things that you need to know. So we'll focus on calculations for a single asset, or if it's a portfolio, we'll focus on calculating expected return. So then there's some information following on from that that discusses risk. And there are 2 key types of risk that you should understand. And they're called systematic risk and unsystematic risk. Systematic risk, I think of as market-wide risk. Systematic risk. For me, I just describe it as market-wide risk. We're talking about risk factors that will affect most companies. So most companies' share prices are likely to be affected by these
market-wide factors. So things like inflation, changes in interest rates, and exchange rates. These are factors that will affect most companies in the market. So changes in GDP, changes in inflation, changes in interest rates, changes in exchange rates are likely to have an impact on most companies. So that's why I say they're market-wide factors, because they'll affect most companies. If these risk factors affect most companies, do you think we can avoid systematic risk? No, we can't avoid systematic risk. So we get higher returns for bearing higher systematic risk because we can't avoid it. It's market-wide. We can't avoid it. The other type of risk is called unsystematic risk. And the way that I describe unsystematic risk, I call it company-specific risk. Company-specific risk, unsystematic risk. So it even says it here, company-specific risk is unsystematic risk. Examples are things like a labour strike at a company. If all the staff go on strike at a particular company, that will affect that company. Other examples might be things like the CEO resigning. If a company has had a chief executive officer, a CEO, that's one of the senior managers at the company. If they've had the same CEO for 15 or 20 years and that CEO announces that they're resigning, that's a risk factor for that company. Now they have to replace this senior manager who had so much knowledge about the company. They're leaving and they have to be replaced. But it's specific to that company. It doesn't affect all the companies in the market. It affects that particular company where the CEO is resigning from. So unsystematic risk factors are unique or particular to a company. Can we avoid unsystematic risk? Yes, we can. We can diversify. What does diversify mean? Yes. Don't put all your eggs in one basket. Put your eggs in other baskets. Invest in different assets so that if one asset is doing badly, the other assets hopefully are doing well and they can sort of cancel each other out. You don't lose all your money if one asset's doing badly. Diversify. Invest in different assets. If you diversify, it reduces risk. The risk that you're reducing is the unsystematic risk, the company's specific risk. You can almost completely eliminate the unsystematic risk by having a well-diversified portfolio. I wouldn't say you can eliminate it 100%, but you can almost completely eliminate it by diversifying. I think there's a table in here that I will show you. This table, which is from the textbook, says if you have one share in your portfolio, one share, the standard deviation in your portfolio returns is 11.49%. So that's the measure of total risk, 11.49%. But if you increase that to, say, 20 shares in your portfolio, and I don't mean 20 shares in the same company, I mean shares in 20 different companies so that you're spreading the risk. You can actually reduce the standard deviation to 5.71%. And you can see there from 20 to 45, the standard deviation doesn't really decrease significantly when you add another 25 different assets into the portfolio. But from 1 to 20, there's a large drop in the standard deviation. So by investing in different assets, you can significantly reduce the total risk. And that total risk is made up of systematic and unsystematic risk. But the systematic we can't avoid. We all have to bear the systematic risk. It's the unsystematic risk that we can actually reduce by diversifying, that company-specific risk. So we've talked about the concept of diversification, investing in different types of asset. So, for example, that might mean don't just buy shares in companies. You might invest some money in shares. You might invest some money in real estate. You might invest some money in bonds, investing in different types of asset. If you do hold a portfolio of shares, you would invest in different companies in different industries. So as it says here, we wouldn't call it diversified. If you said to me, I've got shares in 50 companies, but they're all internet companies, that's not diversified. So we're looking at different assets. If you're investing in shares, invest in different industries to achieve this concept of diversification. So the good thing about diversifying is that you can significantly reduce risk. You can significantly reduce risk, but your expected return doesn't drop as much as the decrease in risk. Your expected return might be a little bit lower than the individual asset. Your risk drops like that, your expected return may be a little bit lower. But most of us, as investors, most of us are risk averse. Risk averse means we don't really like taking risk. We'll only take risk if we get compensated with a higher return. So to have this big reduction in risk for a small reduction in return is a good trade-off for a risk averse investor. This graph that's included in here just shows the blue section is the unsystematic risk, and the pink, I don't know what color that is, the pink section underneath is the systematic risk. And as we add assets into our portfolio, it starts at 1. The number of shares or assets increases here to 100. As we add shares into our portfolio, the total risk drops. You can see the total risk drops a lot from 1 to 10. It drops really sharply. I mean, it even drops a lot from 1 to 20, but then from 20 to 100, there's not a great change in the total risk. So the blue part is the company-specific risk. We can reduce most of it, get rid of most of it, but there's always that little bit there that we can't completely eliminate. And then this bottom section is the market-wide risk factors. So things like interest rates, exchange rates, GDP, inflation, factors that will affect most companies in the market. Are there any questions about systematic or unsystematic risk? So we've talked about this concept of having a portfolio or a collection of assets. And the idea is with your portfolio that you create a diversified portfolio. So you invest in different types of asset. In shares, you invest in shares in different companies, in different industries to remove a lot of that unsystematic risk. So then you get rewarded for bearing the systematic or market-wide risk. So standard deviation measures total risk. That's our measure of total risk for an asset. Total risk is made up of systematic plus unsystematic risk. This systematic risk, we actually measure it as well. We measure systematic risk, and systematic risk is measured using what's called a beta coefficient, beta. I'm not going to show you how to calculate beta. That's a bit beyond the scope of this course. But you should know that total risk is made up of systematic and unsystematic risk. And we can measure systematic risk. We measure it using beta. And if you happen to look at a company that's listed on the stock exchange, if you looked up a publicly listed company, for most companies now, they actually publish a beta, which is their measure of systematic risk. When I was at university, I did my undergraduate degree at Macquarie University, and one of the finance courses I did, our task was to calculate betas. And way back when I was a university student, we didn't have all the data that you can access online like we do now. Things were very different back then. We had very limited access to data. And the only way that we could actually calculate betas for publicly listed companies was to sit in the library and use the databases in the library and try to get information from the databases, historical information that we could use to calculate a beta. But now, if I said to you, what's the beta for ANZ Bank, we could Google it and find their beta online. It's much easier. Information is more commonly published now. There's a lot of investors that are constantly gathering and analyzing information, and there's a lot of published information now for investors. So beta is a measure of systematic risk, and it's a relative measure. If beta for a company is 1, so if ANZ Bank had a beta of 1, that tells us they have the same systematic risk as the market overall. The same systematic risk if beta is 1. If beta is less than 1, all we're saying is that that particular company has less systematic risk than the market overall. They're a bit safer. If there's less risk, what would you expect? Lower returns. And a beta of greater than 1 implies that the company has more systematic risk than the market overall. So if they have more systematic risk, we would expect a higher return to compensate us for that risk.
So it says about how much for the type of portfolio related to the market.
So if you were investing in shares in companies, every company in your portfolio has their own beta. You can actually calculate, I think it's in here, the beta for your portfolio. You would just take the weight of that asset in your portfolio and multiply it by that company's beta, and do that for all the companies that you've invested in and add them all together. So we can measure beta for a single asset, which is what we're looking at here, or we can measure the beta for a portfolio of assets by weighting it.
How does it lower its beta?
That's actually a good question. To be less exposed to factors like interest rates. If I wanted to be less exposed to changes in interest rates, using less debt would leave me less exposed to changes in interest rates. Exposure to foreign exchange rates, having less transactions in foreign currencies would be safer because I'm less exposed to changes in the foreign currency, or using derivatives to hedge my exposure to interest rates or foreign exchange would also help my company to lower its systematic risk.
How does that lower the expected return?
If the risk is lower, if it's safer, then it will be a lower return from investing in that asset. We'll actually have a look. It's in this module, I'm sure. We'll have a look at how we can calculate the expected return from an asset. And in the calculation for expected return, we actually include the beta for the company. It's called the capital asset pricing model. I call it CAPM, capital asset pricing model. It uses this beta coefficient to calculate the expected return from the asset. This table here, it's a little bit old because the textbook is not a 2023 textbook. These were the beta coefficients for some listed companies. So I can see, for example, look at JB Hi-Fi. You guys know JB Hi-Fi? Their beta back in 2019 was 0.39. Very low systematic risk relative to the market overall. And that could be factors like maybe they didn't use a lot of debt. Maybe they didn't have a lot of foreign exchange transactions that helps them to reduce, or maybe they use a lot of derivatives to hedge against those risks. Telstra is 0.62. I can see Domino's Pizza is over 1.35. Each company is different, so there's not one blanket statement that we can't say if their beta is over 1. We can't say, oh, they must all have a lot of debt. That's not the case. Every company is different. So we need to look at each company individually to determine why they're more exposed to those market-wide risk factors. So we've talked about total risk. We measure the total risk by calculating the standard deviation. Total risk is made up of systematic and unsystematic risk. And by having a diversified portfolio of assets, we can eliminate most of the company's specific or unsystematic risk. We measure the systematic risk by looking at the beta for a company or an asset. The higher the beta, the higher the systematic risk. And it's a relative measure. It's relative to the market overall. I mentioned this before. If we have the beta for the individual assets in our portfolio, we can actually calculate the overall beta of our portfolio. So we can see how much systematic risk does our portfolio of assets have relative to the overall market. So in this case, if we have a portfolio and it's made up of these 4 assets, shares in A, B, C, and D, we've got the total amount invested in each asset. So 1,000 in A, 2,000 in B, 3,000 in C, and 4,000 in D. What's the total value of my portfolio if we add all the assets together? 10,000. So my total portfolio has a value of $10,000. So using that total value, I could work out the weight of each asset in the portfolio. And all I need to do, if I wanted to calculate the beta for my portfolio, is calculate the weight of each asset and multiply the weight by the asset's beta. And then add them all together and get the total. So for shares in A, we've got $1,000 invested out of a total 10,000. So what's the weight of share A in the portfolio? 10%. 1,000 divided by the total 10,000, 10% in share A. So 10% multiplied by 0.8 plus we've got 20% of our money in share B multiplied by 0.95 plus 30% of our money is in share C multiplied by 1.1 plus 40% of our money is invested in share D multiplied by 1.4. So it's just the weight multiplied by the beta and then add them all together. So we've actually done that on the next slide. So I've included the calculation to show you how I work out the weighting for share A, B, and you just repeat that for C and D. So the weighting is that we've got 10% in A, 20% in B, in share C, we've got 30%. And 40% in D. So we need to use these weights to calculate the portfolio beta. So to calculate the portfolio beta, we have 10% of our money invested in share A, and the beta of A is 0.8. So the weighting of 10% multiplied by the beta for A, plus the weighting invested in share B, 20% in B, multiplied by the beta of B, plus 30% of our money is in share C, multiplied by the beta for C, which is 1.1, plus 40% of our money in D multiplied by the beta of D. So we get a portfolio beta of 1.16. What does that tell us? More risk than the market overall. It's greater than 1. So our portfolio of shares A, B, C, and D has more systematic risk than the market overall. All that translates to is more return because we're bearing more risk. We can also calculate the expected return from the portfolio. This is good to have a look at this example. To calculate the expected return, we actually follow the same process, but instead of multiplying the weight by the beta, we multiply the weight by the expected return for the asset. So for A, for shares in A, we've got 10% of our money invested in A. The expected return from A, up here it says 8%. So 10% multiplied by 8%. Plus, we've got 20% of our money invested in shares in B. The expected return from B is 12%. Plus 30% of our money invested in share C. And the expected return from C is 15%. Plus 40% of our money invested in share D, and the expected return from D is 18%. So for our portfolio as a whole, for our whole portfolio of those 4 assets, the expected return from the portfolio is 14.9%. And I would expect you to be able to do that if I asked you to do that in the exam. You should be able to calculate the weight that an asset makes up in a portfolio, and you should be able to use the weight and calculate the expected return or the portfolio beta. You should be able to do those calculations for a portfolio. So if you wanted to practice, again, that's a good example, just to practice calculating the weight and using the weights to get the portfolio expected return and the portfolio beta. Are there any questions about that example? So there's 2 things that I just wanted to have a look at to finish off this module from last week. I wanted to have a look at this graph and just consider what it's telling us about an asset. On this axis, we've got portfolio beta, or the beta for an asset. What does beta measure? Systematic risk. So this axis is risk. So as we go across to the right, we're looking at higher systematic risk. And this axis shows us expected return. What happens to the expected return as the beta or the systematic risk increases? What happens to the expected return? It increases as well. So we can see the expected return is going up as the beta or the systematic risk goes up. That's all we need to take from that graph. We already knew that. We know that if we invest in an asset that has a higher risk, we're going to expect a higher return. So we have this ratio called the reward to risk ratio. And this is saying on the top of this equation is what we call the risk premium. I'm going to write that in here. The risk premium. The risk premium is the expected return on the asset minus the risk-free rate. We call it the risk premium. And as beta goes up, so does that risk premium. As beta goes up, as the risk goes up, we want a bigger risk premium to invest in the asset. So on the top, we have the risk premium. On the bottom, we have beta. As beta goes up, that risk premium needs to go up as well to compensate the investor for bearing a higher risk. So that line that we were looking at before, that line is actually showing us that reward to risk ratio. The slope of the line is that ratio. But we know this. We know as risk goes up, we expect a higher return. And with a higher return, we're going to get a bigger risk premium. The risk-free rate down here stays the same. We just want a bigger risk premium as the beta or the risk goes up. We want a higher return, which means a higher risk premium. So I'm actually going to skip ahead now to what's called the capital asset pricing model. And the capital asset pricing model is going to bring together these concepts of beta, which is our measure of systematic risk, and the expected return from an asset. We already know as beta gets higher, the expected return gets higher as well. We know that. But it's actually been brought together in an equation form that we use often in finance. And it's called the capital asset pricing model. It's also referred to as the security market line, or SML. So you might see those terms used: capital asset pricing model, which is written across the top. It's also referred to as the security market line, or shortened to SML. And it's this equation here. So the equation says the expected return from an asset is equal to the risk-free rate. So the risk-free rate means the rate of return from investing in a risk-free asset. we've talked about what we consider to be a risk-free asset in Australia. What is that? Government bonds. So 10-year Commonwealth government bonds are considered to be risk-free. There's considered to be no chance that the Commonwealth government will default on the bond. So a 10-year government bond is considered to be a risk-free asset. So the rate of return on that risk-free asset plus in the brackets here is the risk premium. The expected return on the market minus the risk-free rate. So we've got the risk-free rate twice in that formula, but the part in brackets is just the risk premium multiplied by beta. Actually, we normally put beta on the other side. I find it easier to put it there. If you put it on the end, you can forget it sometimes. So the part in brackets here is just that risk premium. And we know as beta goes up, so does that risk premium. Higher beta means higher systematic risk, means we want a higher return from the asset. So this is what we call the CAPM or capital asset pricing model. We use it to calculate the expected return from an asset. And it's actually going to become important in the next topic that we have a look at, the topic for week 9, where we look at measuring the cost of equity for a company. This capital asset pricing model is one of the methods that we can use to measure the cost of equity for a company. So you're going to see this again when we get to the PowerPoints for week 9. So it's called the capital asset pricing model, and it shows us the relationship between risk and return. And risk is incorporated through beta, the measure of systematic risk. There's an example. We'll have a look at that example, and then we've covered all of the really important information from that topic. So in this example, we're given the risk-free rate of return. The risk-free rate, which is RF, is 4%. The market risk premium is 8.6%. So that's our expected return minus the risk-free rate is our market risk premium. And beta is 1.3. Using the capital asset pricing model, what is the expected return from this share? We need to calculate the expected return using the capital asset pricing model. So the expected return is equal to the risk-free rate plus, I'm just going to put brackets on this, plus the market risk premium multiplied by beta. So the expected return from that asset or that share is 15.18% based on that beta of 1.3%. What would the expected return from the share be if beta doubled? So if beta doubled, then beta becomes 2.6 instead of 1.3. If beta's higher, that tells us more systematic risk. So before we even do the calculation, more risk equals more return. We expect the answer to be higher. So we do the calculations. The expected return from the share now is equal to the risk-free rate plus the market risk premium multiplied by beta. And we get an expected return of 26.36%, which is consistent with what we expected. As the risk increases, so should the expected return. Are there any questions about any of the content from week 8 about risk, total risk, systematic, unsystematic, about beta or the capital asset pricing model? Are there any questions on any of that? So all this capital asset pricing model does is it gives us a definitive relationship between risk and expected return. It allows us to determine the expected return from an asset based on the beta or the systematic risk of the asset. So that brings us to the next topic. And I have to say to you that the information in chapter 12, having a look at the 2 chapters that we've got here in this particular week, chapter 12 is actually a really important chapter, looking at what we call the cost of capital for an organization. In previous weeks, we have looked at measuring rates of return. In fact, in that previous topic, we looked at calculating the expected return from an asset. We call it an expected return or a return from the investor's point of view. If you buy shares in a company, you expect to earn a return from investing in the company. Is it a return to the company? It's not. It's a return for the investor. If we switch and think now from the company's perspective, the dividends and the interest that they pay to their investors, they're not returns for the company, they're costs. The returns that they pay to the shareholders are a cost for the company. The returns they give to the lenders are a cost for the company. So in chapter 12, we're actually going to look at it from the other perspective, not from the investor's perspective. We're going to look from the company's point of view. And we're going to look at how the company measures the cost of giving returns to shareholders and the cost of servicing their debt from the company's perspective. Now, why is that important in finance? If we use something really simple, let's go back to that Word document. What if I put in the document? It's my favorite equation, but what's it called? The accounting equation is all it's called, the accounting equation. On the left side of the accounting equation is the investing decision. The investing decision is what assets should we invest in? And on the right side of the equation is made up of the financing decision. How do we pay for the assets? And whether the company borrows or uses owner's money, there's a cost attached to that. So the cost of capital is going to measure the cost of getting funds or getting financing to invest in an asset. So we're measuring the cost of getting the money that we need to invest in assets. So how is that helpful? It's helpful because this cost of capital is the minimum return that we need to earn from investing in the assets. If my cost of capital is 15%, I need to earn at least 15% from the asset just to cover the cost of getting the money. If my assets earn a return of 15%, I just break even. I'm not making any money. But if my assets can earn a return of 20%, that more than covers the cost of getting the money to invest in the asset. So that's what we're looking at today, this cost of capital, measuring the cost of getting the money to invest in the assets. It's a really important piece of information for a company to know because they need to know that their assets are generating a higher return than their cost of capital. If they're not, the company is losing money. They're going backwards. So there's an additional note here in the PowerPoint that says, if we know our cost of capital, it can help us when we're looking at investing in projects or assets. When we were looking at the investing decision, deciding what assets to invest in, what tools do we commonly use in practice to work out which assets are a good investment? NPV. NPV is our favorite tool, net present value. To use NPV, we need R. We need a discount rate to calculate the present value of the future cash flows. And that's why we need to know our cost of capital. Our cost of capital is an important piece of information when we're determining what R we should use to calculate the NPV. Anyone have any questions so far? Because this is quite an important concept, the cost of capital for an organization. I don't want you to just memorize how to calculate it. I want you to understand its importance. So we've done the investment decision. We've looked at calculating net present value, and we've seen how we can use Excel to calculate the internal rate of return. But when we did that topic, we just gave you the discount rate. We gave you R. We said, this is the company's required rate of return. The company's required rate of return to invest in an asset is largely influenced by the cost of getting the money to invest in the asset. That's a really important consideration because we need to make sure that we can at least cover the cost of getting the money to invest in the asset. Ideally, we want to make money, but we need to at least cover that cost of capital.
Statement below says that the cost of capital depends on the use of the fund, not the source. But we were just discussing how the cost of capital depends upon whether we are getting debt or whether we are revenue.
So what the statement's trying to say, and I would actually say it's not entirely clear in that sentence, is that what's depending on the use of funds is actually this appropriate discount rate R. That discount rate R will be influenced by how we're going to use the funds. Because if I'm looking at two projects and one project is really, really risky, then when I'm evaluating that project, I would use a much higher R because it's really risky. So that's considering the use of the money. If I'm using the money for a really risky investment, then I would use a bigger R. So I would actually say the discount rate depends on the use of funds rather than the source, and that the cost of capital is a factor that affects the discount rate, but so does how we're going to use the money. Yeah, so we need to at least cover our cost of capital when we invest in an asset. We have to at least earn the cost of capital back from investing. But we also would adjust our discount rate depending on how risky the use of funds is. If it's a really risky asset, we would use a much higher discount rate to incorporate that risk. So we've talked about how, from an investor's point of view, it's considered a required return. And when we invest in assets, we need to generate from the asset at least the return that investors want for compensation for investing in the company. That's just saying the minimum return from investing in an asset needs to be the return the investors are demanding to invest in the company. So we know that companies can use liabilities and equity. They're sources of financing for a company. So liabilities, we frequently use the word debt for liability. And when we look at equity, sources of financing from equity, we look at shares. So companies can issue ordinary shares. Ordinary shares are the most commonly issued shares by a company. They're the most basic unit of ownership in a company. And companies can also issue preference shares. So when we're trying to measure the company's cost of funds or their cost of capital, we need to consider debt and equity. We'll start by having a look at equity. We'll start by looking at how we could measure the cost from the company's point of view of getting money from shareholders. From the shareholders' point of view, what's it called? The return. So the company's cost of equity is the shareholders' required rate of return. So that's what we're going to look at. The cost of equity is the return that investors need or require to invest in the company. And there are two methods that we can use to calculate the company's cost of equity. Two ways of doing it. And sometimes in practice, we might use both, but it really comes down to what sort of information we have access to as to which method we might be able to calculate in practice. So the first one is the dividend growth model approach. Now that'll be stretching your memories. I think that was week 5. We looked at calculating the value or the price of a share in a company. We talked about calculating the value of a share, and the value of a share was the present value of the future dividends. And there were a couple of models that we looked at in week 5 that we could use to determine the value of a share in a company. There was one where there was zero growth called constant dividend. So that was just a perpetuity. There was also a model called the constant dividend growth model. So dividends were increasing at a constant rate of growth called G each year. We looked at using that to estimate the value of a share in a company. And with the first method here, that's what we're using. The constant dividend growth model. But instead of calculating P, the price, we're going to calculate R, the shareholders' required rate of return. So we've covered this in week 5, but we're just rearranging the equation to find R instead of finding P. It's the same equation. The other method, which we just had a look at, is the capital asset pricing model, or the security market line. And that was an equation that allowed us to calculate the expected return. So the cost of equity for the company is the return that investors expect to get from investing their money in the company. So let's start with the constant dividend growth model from week 5. In week 5, we looked at it in the format that it is on the top here. In week 5, we were trying to calculate the price. And we said the price today for a share in a company is equal to D1. What was D1? The first or the next dividend to be paid, all over RE. RE is the shareholders' required rate of return. But in week 5, we were given the shareholders' required rate of return. And we subtract from that the growth rate in dividends called G. Or the other version of that formula is D0 multiplied by 1 plus G all over RE minus G. What's D0? Dividend just paid. So D0 if we have the dividend that they've already paid, or if we know the next dividend, then we would use D1. So in week 5, we used these formulas to find P0. All we've done is rearrange the formula to find the shareholders' required rate of return. So the shareholders' required rate of return is equal to D1, so the dividend, the next dividend, over the price, plus the constant growth rate in dividends, or D0, the dividend just paid, multiplied by 1 plus the constant growth in dividends, all over the price plus G, the constant growth. So there's an example here. In this example, it says Great White Cleaning Limited paid a dividend of $4 per share last year. So is that D1 or D0? So I've got D0. So I need to use this version with D0. The share currently sells for $60. So that's my P0, the price. Got P0. And you estimate the dividend will grow at 6% per year into the future. So we've got G. So we've got D0, P0, and G. So we'll use the second version of the formula to find RE. So the shareholders' required rate of return from investing in those shares is 13.07%. So that means if you're the shareholder, you expect to get a return of 13.07% if you invest money in shares in the company. From the company's point of view, that's a cost. The company has to earn a return of at least 13.07% from their assets so they can give you the return that you need on your shares. So this 13.07%, it's what you, the shareholder, expect to get from your investment. It's the minimum that the company needs to earn from an asset so they can cover the cost to you to give you those returns. So we've looked at using the dividend growth model approach. This was a simple example because in this example, we were given the dividend, we were given the price, and we were given the growth rate. In practice, if I had to do this in practice, if I had to work out the shareholders' required rate of return, I can easily get dividend information. That's all published online. I can see how much dividends the company has paid. I can also get the company's share price, but companies don't normally publish the growth rate in dividends. So what we would do if I was trying to do this in practice is normally we would have a look at their historical dividends and estimate the average growth rate in their dividends over a period of time. And this example here is quite limited because we're only looking at 4 growth rates. So this percentage change is the growth in the dividend from year to year. So from 2014 to 2015, the dividend grew by 10 cents or 9%. From 2015 to 16, the dividend grew by 15 cents or 12.5%. So what I would do is I would actually get a lot more data than that. I would want to get 10 or 15 or 20 years of dividend data. I would calculate the growth each year and then find the average. So when I had all my percentage changes, and I would do it over a much longer period of time, I would then average the percentage changes. And I would say that if you wanted to do that with any sort of reliability, you would need to have at least 10 years of data. So it's easy for you, we give you G. But if you were trying to do this in practice, you either need to estimate G from historical data, or you might be able to find a forecast growth rate that's been published by an analyst. And I can tell you now, when I worked at Macquarie Bank, we didn't give away all our inputs and our secret information that we had in our spreadsheets. We gave away very limited information. We didn't explain in too much detail how we came up with the share price because all of that information has been developed internally and analysts don't want to give away too many of their secrets. So it's difficult to get an analyst forecast. It's much more common and it's easier just to use historical data, calculate the growth rate from year to year, and then find the average growth rate over the years. But you don't have to do that in your exam. If you need G, I'll give you G just because it's efficient in an exam situation. But if you were trying to do this for your own purposes, then you would gather a lot of historical data. So we do use the dividend growth model to calculate the shareholders' required rate of return. But there's one very big limitation. And the limitation of this model is it only works if it's a company that's actually paying dividends. So if you were trying to calculate the shareholders' required rate of return from a relatively new company that hadn't been around for long and hadn't started paying dividends yet, that's not a method that you can use. You can only use it for established companies that are already paying dividends. And as it says here, it's also only really useful if the company's growth rate is relatively consistent over time. If the growth rate is really volatile from year to year, so if you're looking at these percentage changes, and if there's huge changes from year to year, it's not going to be a very reliable method to use. But the biggest limitation is the one that I highlighted. We can only use the dividend growth model to calculate the cost of equity if the company is actually paying dividends. So the other way of determining the cost of equity or the shareholders' required rate of return is using the capital asset pricing model, which we just had a look at. Using the capital asset pricing model, we start with that equation. The equation says the expected return is equal to the risk-free rate plus beta. What does beta measure? Systematic risk multiplied by the market risk premium. So there's an example here that says CSL had a beta of 0.87. So we've got beta. The risk-free rate, so RF, is 2.5%. And the market risk premium is 5.42%. So that's our expected return on the market minus the risk-free rate. So the cost of equity or the required return from investing in that company is equal to the risk-free rate plus beta multiplied by the risk premium. So that means shareholders require a return of 7.22% to invest in shares in CSL. So from the company's point of view, that's their cost. They need to earn at least 7.22% from their assets to be able to give that return to the shareholders. So we looked at two different ways of calculating the cost of equity from the company's point of view. The cost of equity is just the required return for the shareholders. We can either use the dividend growth model method, which we looked at in week 5. That one only works if it's a company that's paying dividends. Or we can use the capital asset pricing model or the security market line. The good thing about using the capital asset pricing model, like we did here, is it takes risk into consideration. In that dividend growth model that we looked at here, there's no way of incorporating risk. We haven't taken risk into consideration specifically anywhere. So the good thing about this is we can explicitly consider the risk through beta, the measure of systematic risk. So in terms of the advantages, we like it because it adjusts for risk. It takes risk into consideration. The difficulty used to be with this method that we have to estimate beta. Estimating beta is not such a big deal now, but the issue with beta is it's not static. Beta changes over time. From day to day and month to month, a company's beta will change. So that means if we're using this method to estimate the cost of equity, we need to keep checking it because it's likely to change over time as beta changes. Are there any questions about those two ways of determining the cost of equity for a company? If there's no questions, guys, why don't we pause there? All right, let's continue from where we left off. So before the break, we were talking about how a company might measure their cost of equity, which is the rate of return required by shareholders for investing in the company. We talked about using the dividend growth model if a company is actually paying dividends. And we also talked about using the capital asset pricing model to estimate the company's cost of equity. So there's an example in the PowerPoints that we'll have a look at. So the company is called Red Center Air Freight. The company has a beta of 1.2. the market risk premium is 8% and the risk-free rate is 6%. All of that information there will allow us to use the capital asset pricing model, the CAPM equation. We've got beta, the market risk premium, and the risk-free rate. So we could use the capital asset pricing model or the security market line to measure the cost of equity. We're also told their last dividend was $2. What's the last dividend? D0. We've got D0. Dividends are going to grow at 8%. So we've got G, and the current share price is $30. We've got P0. What is their cost of equity? So if we use the capital asset pricing model or the security market line, the cost of equity, the required rate of return to shareholders, is equal to the risk-free rate of 6% plus beta multiplied by the market risk premium. So using CAPM, the cost of equity is 15.6%, but we've got enough information to also use the dividend growth model. Using the dividend growth model, we had D0. So D0 is $2 multiplied by 1 plus G, G is 8%, divided by P0, P0 is 30 plus G. So using the dividend growth model, the cost of equity is 15.2%. And as it says here, they're actually fairly similar, 15.6 and 15.2. So if we were doing this exercise in practice, what we could do is say, let's just take an average because they're quite close. We might just take an average and use the average as the cost of equity of 15.4%. So you can see that we can use either or both to measure the cost of equity. This is measuring the required rate of return to the ordinary shareholders in the company. But companies can get their money from debt and equity. So we also need to be able to measure the company's cost of debt. If we want to measure their overall cost of funds, we need to know the cost of the debt and the cost of the equity. So when it comes to debt, ideally, when we measure the cost of debt, ideally, we would be looking at new issues of debt that would happen in the future, ideally. In an ideal world, if I wanted to measure the cost of debt, I would be trying to estimate the cost of debt on new issues of debt that would happen in the future. And the other thing with measuring the cost of debt, we normally focus on the long-term debts. So companies will have lots of short-term debts like payables and overdrafts. Normally, when we're trying to measure their cost of capital, we're normally looking at their long-term funding. Equity is very long-term. Shares don't have a maturity date. And we focus on the long-term debts. So long-term loans or bonds that are issued by the company for a long period of time are what we focus on when we're trying to estimate their cost of debt. In practice, there are two methods that we can use to measure the cost of debt. Method 2 is the ideal method that we would like to always use, but it's not always practical. Method 2 says that we estimate the rates on new debt that will be issued in the future. We estimate the yields or the cost of bonds that would be issued in the future. That's ideally, but that's difficult to do in practice. So in practice, we normally use method 1 because it's easier to implement. Method 1 is just calculating the yield on the company's existing debt that they have on issue. Existing, not new. So we're actually looking at all the debts they've already got on issue and working out the cost of their current debts that they have on issue. Yes, so that is ideally how we would like to measure the cost. Ideally, we want to focus on the debts that would be issued in the future to finance the investment in the asset. But sometimes it's difficult to estimate those future yields on bonds. And the closest thing that we have is to use the yield on the bonds that we now have on issue rather than estimating future ones. I mean, you could say if the yield on a bond that you have on issue now is 5%, you could say, I estimate the yield on the new debt will be 5% because that's the debt on our current issues. You could justify it that way, but the reality is that we would typically just have a look at yields on bonds that we already have on issue because that's data that is tangible and real. We can verify that data, whereas estimating what might happen in the future is less reliable. So that definition is how we would measure the cost in an ideal world, and method 2 is very consistent with that definition. But in practice, we often have to just use existing debts rather than the new debts. Now, I'm not going to ask you to calculate the yield on debt. So if you need to calculate a cost of capital for a company, I'm not going to get you to calculate the yield on debt because the easiest way to calculate the yield is using Excel or a financial calculator, and I don't expect you to do that. So if you need to know the cost of debt, I'll give you the cost of debt. If that's an input that you need to work out the company's cost of capital, I'll give you the cost of debt. But you should know, ideally, we want to measure the cost of new debt, and we focus on long-term debt. They're two key things when it comes to the cost of debt. So we've looked at the cost of ordinary shares, the cost of equity, which was ordinary shares. We've talked about the cost of debt. The other thing to consider is just measuring the cost of preference shares if the company has preference shares on issue. Not all companies issue preference shares. All companies issue ordinary shares, but they don't all issue preference shares. So this is relevant to some companies, but not to all companies. So a preference share is a share that pays a fixed dividend. The dividend is usually a fixed dollar amount. And when we talked about estimating the price or the value of a preference share in week 5, we talked about these in week 5. And the value of a preference share is the present value of the future cash flows. The future cash flows are those fixed dividends every year. So when we looked at this in week 5, we said P0 is equal to the dividend divided by R, which is just the present value of a perpetuity formula. The present value is equal to the cash flow, which is the dividend divided by the rate of return. So it's a perpetuity. The price is the present value. We're just rearranging this formula to focus on R. So RP means the required return for preference shareholders, RP. The required return for preference shareholders is equal to the dividend divided by the price. So it's a simple one because it's a perpetuity. It's a more simple calculation. It's a fixed perpetuity. So in this example, this company has preference shares on issue. And in March 2019, the preference share was selling for $103 per share. So that's the P0 at the time, $103. And they pay a fixed dividend of 7% per year per share. So that means 7% of the face value of the preference share when it was issued. 7% of $100 is a $7 dividend. So the dividend is always $7. It never changes. So that's our D, our dividend. It's $7. So the fixed dividend on the preference share is $7 and the share price is $103. What's the cost of the preference shares? The cost of the preference shares, RP, is equal to the dividend divided by the price. The dividend is $7, the price is $103. So the cost of the preference shares is 6.8%. So that means the investors require a return of 6.8% from their preference shares. That's the cost to the company. So we've looked at measuring the cost of ordinary shares. That was what we looked at first. There are two methods that we can use to measure the cost of ordinary shares: the dividend growth model, or we can use the CAPM equation to measure the cost of equity. What was the limitation with using the dividend growth model? The main limitation? Yeah, if the company's not paying dividends, we can't use that method. We have to use the CAPM equation. But the CAPM equation is good because it uses beta, so it incorporates risk into the calculation. So we looked at measuring the cost of ordinary shares using the dividend growth model or using the CAPM equation. We talked about how to measure the cost of debt, but I'm not going to get you to calculate the cost of debt. I would give you the cost of debt if you need it. And we've just looked at how we can measure the cost of preference shares if the company has preference shares on issue. We need to bring it all together now. Companies potentially could have those three sources of funds. They could be raising money from ordinary shares, preference shares, and they might have issued some bonds. They could have three sources of funds, and we need to work out their overall cost of funding or cost of capital. We call it the weighted average cost of capital. Weighted average cost of capital, which we just shorten to WACC. Weighted average cost of capital. And this is what we mean when we talk about the cost of capital. The weighted average cost of capital is the return that the company needs to earn on their existing assets. It's the minimum return they need to earn on their assets so they can provide the required returns to their investors. It's got the word weighted in the name. So that means if we have ordinary shares, preference shares, and some long-term debt, we don't just add the three costs together and use a total. We calculate a weighted average. How do we weight the costs of ordinary shares, preference shares, and debt? We weight the costs using the market values. The market value of equity, the market value of debt is how we assign a weight to the cost. Like we did with a portfolio. We calculated the weight of each asset in the portfolio and we multiplied that by the return from the asset. We do that here. We calculate the weight of equity in the company's total financing. We multiply that weight by the cost of equity. But the key with weighted average cost of capital is ideally we want to use current market values to measure the weight for equity and debt. Ideally, current market values. Sometimes we find it difficult to get access to current market values for equity or debt, and we might have to use what's called a book value. The book value is just the value on the balance sheet. But if we can, we prefer to use the current market value to weight the equity and debt. So we're saying the total value of the firm or the company is equal to the market value of equity plus the market value of debt. The total value of the company is equal to the market value of equity plus the market value of debt. So right down the bottom here, you can see then we determine the weight. So this is actually the weight of equity. And the weight of equity is E. E is the market value of equity divided by V. V is the total market value of the company, the equity and the debt added together. So the weight of equity is E divided by V. And the weight of debt is D divided by V. So we're weighting the cost of the equity and the cost of the debt using the market values, the current market values of equity and debt. Now, it's easier to understand what that means by having a look at an example, and there's an example that we can go through. But before we have a look at the example, there's a formula. And the formula is what we use when we're trying to calculate the weighted average cost of capital. The other thing that we need to note is this point here that says, if a company pays interest on debt, if they're paying interest on debt, it reduces the amount of tax they have to pay. There's actually a tax saving from the interest on the debt. And because of that tax saving, we use the after-tax cost of debt in the calculation of WACC. Because any interest that we pay on the debt will reduce our tax bill. We get a tax saving out of it. And the point underneath is also an important one. Dividends that are paid on shares, they're not a tax deduction. There's no tax saving from paying dividends. So we don't measure the cost of equity after tax. There's no tax impact on that cost. So we measure the cost of debt after tax, but there's no tax impact on the cost of equity. And it's because interest reduces our tax bill. It's a tax saving for us if we incur interest. So on the next slide are the formulas for WACC. And then there's an example to follow. So the formula at the top says the weighted average cost of capital is equal to E divided by V. So that was the weight of equity, the proportion of their funding that's made up of equity, the weight of equity, multiplied by the cost of equity. And in fact, we should really put brackets around that. So the weight of equity multiplied by the cost of equity, plus the weight of debt multiplied by the cost of debt, but we want to measure the cost of debt after tax because the interest will allow us to save a little bit of tax. So we multiply by 1 minus the company tax rate. So this formula across the top is the formula if the company just has ordinary shares and debt. The formula underneath, the only difference is it includes preference shares. That's the only difference. Underneath includes a weighting and a cost for preference shares. So the formula across the top is the more commonly used one because not all companies have preference shares on issue. So the weighting of equity in the total value of the company multiplied by the cost of equity plus the weight of debt in the market value of the company multiplied by the cost of debt, but we want the cost after tax, so we multiply by 1 minus the company tax rate. So if we have a look at this example, in this example, the company is the Brumby Forest Group. They have 1.4 million ordinary shares on issue, and the current share price is $20. I'm looking at that thinking, I can use that to work out the market value of equity. One share has a market value of $20 and they have 1.4 million shares on issue. They have debt. They also have debt and it's traded. So that's good. We can get a market value. The debt was recently quoted or traded at 93% of its face value. So this will help us to work out the market value of the debt. The total face value of the debt is 5 million and the market value is 93% of that face value. It's currently priced to yield 11%. The 11% is the cost of the debt. The current yield is the cost of the debt. So we can work out the market value. It's 93% of the face value, and we've got the cost of the debt. We've got the risk-free rate, RF. We've got the market risk premium, and we've got beta. What method are we going to use to work out the cost of equity? CAPM. We've got beta and risk-free rate and the market risk premium. So to work out the cost of equity, we're going to use all of this data here to work out the cost of equity and use the CAPM, because that's what it relates to, using the CAPM. We've also got a company tax rate of 30%. We need to calculate the weighted average cost of capital. So the cost of equity using the CAPM equation is equal to the risk-free rate, RF, plus beta multiplied by the market risk premium. So the cost of equity is 13.18%. We can add in the cost of debt before tax was given as 11%. They said the yield on the debt is currently 11%. So we've got our cost of equity. We've got our cost of debt before tax. We need the after tax. The market value of equity, 1.4 million shares at $20 per share, is a market value of 28 million. And for debt, the market value of debt, it's trading at 93% of its face value. So debt has a current value of 4.65 million. So these weightings that are here, let's just change them. So it's E over V. So 28 million is the market value of equity, and V is E plus D. So 28 over, what just happened there? Where did we go? 28 over 32.65. So 32.65 is equity plus debt, the total value of the company, equity plus debt. Because we saw before, we saw V equals E plus D. So I've added them together to get V. So V is 32.65. So the weighting of equity is the market value of equity all over the total market value, multiplied by the cost of equity. The cost of equity is 13.18%. Plus debt. So debt is 4.65 million out of a total 32.65 million. So I've got my market value of debt divided by the total market value of the firm, multiplied by the cost of debt. The cost of debt was 11%, but we want the after-tax cost. So multiplied by 1 minus this 0.3 is the company tax rate of 30%. 1 minus the company tax rate. So their weighted average cost of capital is 12.4%. So why do we need to know that? That's the minimum that they need to earn from their assets. They need to earn at least 12.4% from their assets to be able to give the required returns to the debt holders and the shareholders. If they earn less than 12.4%, the value of their assets would drop. They need to earn that return as a minimum. So it's a really important piece of information for a company to know. They need to know the cost of their equity and their debt so they know what sort of returns they need to generate from the assets they invest in.
I understand how to calculate the value of
D?
Yeah.
So D, they said it's publicly traded and it's been trading at 93% of the face value. So that means the latest prices are 93% of face value and the total face value is 5 million. So that's all we have to go off. So all we can do is say, what's 93% of 5 million? And that's what we estimate the market value of the debt is currently.
That's 5 billion debt total.
So when the debt matures, at maturity, the face value is 5 million. They'll have to pay $5 million to settle it. But that's what it's currently trading for between investors. Because remember, the investors will get their coupons as well. Yeah.
So 90% value is what an investor will buy. So if an investor was to give us debt, you would have to pay 90% of whatever.
Yeah. 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 So we'll just have a quick look at the factors that can influence a company's weighted average cost of capital. The first one's pretty important. Yeah. The cost of capital. With any shares, with ordinary shares or preference shares, dividends are not a tax deduction. So what the companies actually do is the companies pay the dividend out of after-tax profit. So there's no tax savings if they pay dividends to the shareholders. That's why we don't consider the company tax rate in that formula. I'll just go back to it. In that formula, we don't consider the company tax rate for the cost of ordinary shares, and we don't consider it for preference shares because there's no tax savings from paying dividends. Only from paying interest on debt. Yeah. So the weighted average cost of capital is something that financial managers need to know for their organization. It's quite a dynamic number. It's something that doesn't stay the same all the time. It changes. The weighted average cost of capital is affected by current conditions in the market. So things like interest rates. Interest rates will have an impact on the weighted average cost of capital. If you think about it, if interest rates go up, the cost of debt will go up. If market interest rates are going up, the cost of debt will go up as well. That will impact on your weighted average cost of capital. Other factors, market conditions, tax rates can impact your weighted average cost of capital. If the government increased or decreased the company tax rate, that would impact our weighted average cost of capital because the cost of debt is measured after tax. And if the market risk premium changes, that market risk premium will influence the cost of equity, so it will influence our cost of capital. So typically, market factors like interest rates and taxes are likely to have an impact on the weighted average cost of capital. The company's capital structure will influence their weighted average cost of capital. Capital structure refers to the use of debt and equity in the company. And I think we've talked previously about how the cost of debt is lower than the cost of equity because the shareholders are taking more risk when they invest in the company. So debt's cheaper than equity. If a company has a capital structure where they rely heavily on debt, they would have a lower weighted average cost of capital. And changes to the capital structure will change the weighted average cost of capital. And what they choose to invest in will typically affect their weighted average cost of capital. If they invest in riskier assets, they would generally have a higher weighted average cost of capital. If the asset's riskier, they need to generate higher returns to compensate the investors for bearing that risk. So we've looked at cost of ordinary shares, cost of preference shares, cost of debt. Remember, cost of debt is after tax. And we've brought that together with the weighted average cost of capital. I think there's some questions. We'll have a look at the questions. We won't answer that one, but we'll have a look at these. The first question says, what are the two methods or approaches that we can use to determine the cost of equity? Yep, dividend growth model and the capital asset pricing model, or it's also called the security market line. So they were the two approaches. The limitation with that dividend growth model is just that if the company's not paying dividends, we can't use it. When we work out the cost of debt, what should we use for the cost of debt? Long term, and what was the other key thing? It should be after tax. Remember, we talked about how it should be the cost of new debt issues. Ideally, if we can estimate the cost of new debt. So the cost of new long-term debt is what we try and focus on. And we do prefer to measure it after tax because the interest is a tax deduction. To calculate the weights, the weight of equity and the weight of debt, what should we use? Should I use the book values from the balance sheet? What should we use? Market value. So we should use current market values to calculate the weight, equity, and debt. And how would you explain what the weighted average cost of capital is? Yep, exactly right. Yep. Are there any questions about anything that we've covered so far in looking at weighted average cost of capital and looking at the cost of equity or debt? Any questions? It's just really important in that section, really, that you understand what we use it for. There's no point trying to do the calculation if you don't understand why we're actually using that calculation. And every financial manager should be aware of their organization's cost of capital, because that's that minimum hurdle. They need to get that return at least from their assets to cover the cost. we might pause there. We might leave chapter 13 and look at chapter 13 next week. To be honest with you, there's a lot of information in chapter 13 that's not overly important for you guys. There's really a few key things that we could talk about next week. We've covered what I think is super important with the cost of capital from the first chapter there. What I wanted to do was to have a look at the assignment. I didn't want to run out of time to open up the assignment question and have a look at the assignment. And also to let you guys know that one of the learning advisors is coming to our class next week. So I thought if we can have a look at the assignment question this week, and you can go away and start thinking about the question and how you're going to research it, you might actually have some questions for Adam when he comes next week. Or you might decide to book an appointment at the library or with one of the learning advisors to discuss how you can start answering the assignment questions. So I'll stop sharing that one and I'll go to Canvas. And I'll open up the assignment. So the assignment's worth 25% of your total assessment. So you've done 25% in the 2 mid-trimester tests together. They're a total of 25%. This assignment on its own is weighted as much as those 2 tests. And I'm saying that because if you've done the 2 tests and when you get the test back next week, if you don't have really high marks in the 2 tests, this is a really good opportunity to get a good mark out of 25. By putting a lot of effort in, seeing the learning advisors, asking questions and getting help, you can get a really good result out of 25 in this assignment. So I'm just pointing out that there's still an opportunity to get some good marks before you go into the final exam by putting a bit of effort into this individual assignment. So it's due on Monday of week 12 and it's due just before midnight on the Monday. So submission through Canvas, there's a link on Canvas where you can submit your document. You can submit now if you want, it's open for submissions, and you should try and submit your document a bit earlier so that you can see the similarity report that comes up from Turnitin. And I'm not saying have a look at the similarity report because I'm thinking you're going to copy. I actually think the similarity report's a really good tool that can help you work out if you need to improve your referencing anywhere. Because often those similarity reports will highlight areas that you might have tried to paraphrase from a source and maybe you didn't paraphrase it well enough and you might need to look at working on that again, or you might be missing an in-text reference somewhere and the similarity report can highlight that. And I just think it's really good when you're doing academic writing to make sure that you can get a draft ready and submit it a bit earlier than the due date so that you can have a look at that Turnitin report and see if you need to make any improvements to the document. If you're submitting late without an approved extension, you lose 10% of the 25 marks. So you lose 2.5 marks for each day that the assignment's late, but that shouldn't be an issue because ask questions, get help, and just make sure that you can submit on time. So for the assignment, you're consulting to a superannuation fund, and your task is to write a report on the financial management over the last 5 years of a listed company. A report on the financial management. We talked about financial management in week 1. And we talked about how there are some key decision-making areas in financial management. The first decision is the investing decision. What assets should we invest in? The second decision is how to pay for the assets, the financing decision. The financing decision is also referred to as the capital structure decision. The third decision is looking at working capital management. Working capital management is looking at your current assets and your current liabilities and making sure that you have enough short-term assets to settle your short-term liabilities on time. And the fourth area of importance for financial management is the dividend decision. Should we pay a dividend to the shareholders? If so, how much and in what form are we going to pay the dividend? I'm going to download this document. So, it's a PDF. I can't edit it. So in terms of financial management, they were the areas that we talked about in week 1, and they're really the focus of the requirements if you've had a look at the requirements. So to get started, you need to choose a company. It has to be a company that's listed on the ASX. And I thought it makes it easier if it's one of the bigger listed companies. There's lots of information available. So I put up a link to go to the ASX 200. And if you scroll down, this is the ASX 200 list. All the companies listed here are included in the ASX 200. So these are pretty large publicly listed companies. And if you don't know what they do, you can have a look at what the company does. You can search up the company's code. If I go to asx.com.au, I can search any company's code on this website in the search box. So let's pretend I don't know what Afterpay does. Does everyone here know what Afterpay does? I'm really glad that you said no. That's really good because I don't like Afterpay. Afterpay is an evil service. It's what a lot of young people use. A lot of young people spend beyond their means. They earn $500 or $700 a week and they spend $1,000 a week. How do they do that? They use services like Afterpay. So they go to a shop or a hairdresser and they can't afford to pay. So they have an Afterpay account and the shop adds it to their bill with Afterpay and they pay later. So a lot of young people, it's sort of like a credit card. You can use Afterpay and pay later, but a lot of young people use Afterpay all the time and owe huge amounts of money. So I think it's evil because they allow young people to spend beyond their means and I don't know how they're going to pay it back. So let's not look at Afterpay because I don't agree with what they do. I think they're very unethical. Let's look at the A2 milk company. So A2M, the code is A2M. So on the ASX, I would type in A2M and search. So that's the code I put in, A2M. And the first thing I see is a graph of the company's share price. That's not what I was actually looking for, but that's obviously what's most important to people when they come to the website. They're most interested in seeing the company's share price. There's information about dividends. There's information about company announcements. When I did the search, it actually told me that this company, what industry the company is in. It says it here, food, beverage, and tobacco. But if you wanted to get more information about exactly what the company does, you can Google the company, and most of these big companies have their own website, and they will very proudly tell you what they do. So the good thing about choosing these companies off the ASX 200 list is that they're publicly listed. There's lots of information available about them. And the ASX website is a good source of information. We don't just have to get price data from there. They have information about dividends as well, which can be useful. So that's one of the first things I want you to do. Go to that list and choose a company. And it's more interesting if you're interested in what the company does. So I wouldn't just pick the first company on the list. I would actually look at some companies, read about what they do, and choose one where you're actually interested in what they do, because then it's easier to write about them. So choose a company. You will then have to analyze that company's financial management over the last 5 years using publicly available data. That's all we have to go off. Whatever's published online, we can use to analyze their financial management. And you're going to submit your analysis in a report format. And I want it to be professionally presented. So your report should answer these requirements, and it should be in the professional format. So I want your report to have an introduction. So introduce the purpose of your report and the company that you're going to discuss in your report. And then within the body of the report, please use headings. It's so much easier to follow if you can put headings in the body. Sometimes people write a report and the body of the report might be 2 pages, and without headings, it's actually really difficult to see, have you addressed all the requirements or not? So use headings, and your headings could be driven by these requirements. So your first heading in the body could be introduction to the company. Your second heading could be risk analysis. Your third heading could be capital structure analysis. So using headings in the body will just make it much easier to make sure that you've addressed all the requirements and follow what you're writing about. I want a conclusion. So you're going to consider different areas of their financial management, and I want a conclusion. Do you conclude that the financial management seems to be appropriate and reasonable? Or when you've been researching the company, maybe you uncover some information and might think the financial management was really bad and they made some bad decisions and they could do better. And if you think they can do better, give them a recommendation of what they can improve. So the introduction would be fairly short, the body will be fairly long, and then the conclusion will be brief at the end. I would expect, because these are all large publicly listed companies, I would expect that you're not going to find anything that's too exciting or sinister going on in their financial management, because they're publicly listed companies. So overall, I would expect most of your conclusions are going to be, they seem to be doing a pretty good job. And it would be hard to recommend changes if you think they're doing a pretty good job. Don't forget to include a reference list. So make sure that you put a reference list that doesn't count in the word count. And if you have detailed data, like if you get the report from the database and you wanted to include that, any really detailed data put in an appendix rather than putting it into the body of the report. It's good to put small tables and graphs in the body of the report, but really big tables, like a massive table that would take up half a page, is too detailed. I would put that in the appendix and summarize it in the body of the report. So within this format, within the report format, the first thing I want you to do, and this is probably the easiest part, is introduce the company. Tell me about the company. What does the company do? What are their operations? Don't assume that I know what the company does. I may not know what the company does. What industry do they operate in? How do they generate revenue? What activities do they do to generate revenue? And who are the main competitors of that company in that industry? And depending on the industry, in Australia, some industries are very heavily regulated. For example, if you chose a bank off the ASX 200 list, Banks are heavily regulated in Australia. There's a couple of government bodies that are very important regulators, and you should mention those when you talk about the company and the industry. So I've said that's worth 8 marks, and you don't have to write a huge amount. You're just introducing the company, what it does, how they generate revenue, who they're competing with, and if there are any important regulators. The second part, I think the second part's actually one of the toughest parts to do, is to try and identify the risks that that company faces. This is where you might want to do a bit of research online, because someone else may have already looked at that company and looked at risks, or there could be news articles that have come out recently about risks that companies are facing. And I want you to think quite broadly. So global issues. We've got a lot of issues going on in the world at the moment. Do any of these current issues affect your company that you've chosen? For example, if you chose a company that's producing oil off the list, then you might need to discuss the issue that's going on with Israel at the moment, because that's likely to have an impact on oil prices, which would then impact on your company's business. So I want you to think at an international level. Are there any things going on around the world that might impact on your company? Are there any things going on in Australia that might impact on your company, or things within the industry, or particular issues that relate to your company that might have been discussed in news articles recently? A Google search will reveal a huge amount of information about a company, but you need to go beyond that. But I'm just saying, to look up risk, I want you to think very broadly. So think from an international level and sort of move down, and then look within Australia and within the industry and look at the company and see what risks do you think this company is facing. I think that's probably the hardest part of the assignment. So that's worth 10 marks out of the total. I want you to describe the company's capital structure, how it is now, and how it's changed over the last 5 years. Capital structure means the use of debt and equity. Capital structure means debt and equity. So you're looking at whether the company is more reliant on debt or equity now, and has that changed much over the last 5 years? For some companies, it will have changed a lot, and for other companies, it won't. Every company will be different. So analyze the capital structure. I'll show you that the database, and you can have a look and see if there are any ratios in that database that might help you analyze capital structure. So the use of debt and equity. I want you to look at the company's dividend policy. And by dividend policy, I just mean, are they paying dividends? How much are they paying? And does it change much from year to year? Dividend policy is really nothing more complex than that. Does the company pay dividends? ASX 200, I would expect lots of those companies are paying dividends. And I would also expect their dividends would be fairly consistent from year to year, but that's for you to find out. I want you to have a look at their dividends, and you can get dividend information from the ASX and see, have there been any significant changes in dividends over the last 5 years? And if there have been changes, see if you can work out why. For example, COVID. During COVID, some companies decreased or stopped paying dividends. So that would show up in your analysis if your company was affected by COVID. So capital structure is looking at debt and equity. Dividend policy, I want you to look at the dividends that the company has been paying. Liquidity is looking at what's called working capital. Working capital means current assets and current liabilities. Do they have enough current assets to settle their current liabilities on time? It means we look at their working capital. We want to have a look at their current liquidity or current working capital and look at how that's changed over the last 5 years. And again, liquidity or working capital might have been something that was affected by COVID. If your company was in an industry that was impacted by COVID, you might find that during that COVID period, their levels of working capital may have decreased, or for some companies, they increased significantly as a result of COVID. So have a look at their working capital or liquidity now and see, has it changed much over the last 5 years? And then the last part is just bringing it all together and providing an overall conclusion, which is this conclusion here as a part of the body, after the body of your report. So an overall conclusion, whether you think they're doing a good job of the financial management, have you identified anything they could improve on? If you're looking at the capital structure, you might have noticed that they use a lot of debt in the capital structure. You might have a recommendation around making changes to the capital structure, or if it's a company that's using a lot of equity and not much debt, you might recommend that they use more debt and try and get benefits from leverage. So you might find that there are some areas where you can make a recommendation. It'll be hard because these are all big publicly listed companies and typically financial management is quite good, but you might find after you do your analysis that there are a couple of things you can recommend. So what I wanted to do was just to go to the library. So I've gone to the library page and I just go down to databases, and the database that you can use starts with D. So I click on D and it's the first one. And so with this database, there's a whole host of tools, and I'm not going to show you all of them just because we're running out of time. I'm going to show you a simple one, but you can have a look at this at home, or you can make a booking at the library and get someone to sit with you and help you to work through how to use the database. But the company I picked was A2 Milk. So let me put that in here and see what we can get for A2 Milk. So right at the top, it gives me a summary, a company summary, and I'm just going to open up the summary to be quick, but you can use all sorts of different tools and look up information about companies. So it actually gives me a summary of what the business does here, in case you didn't know what they do. There's a graph here of the company's share price. And then what's interesting are some of these measures down the side here. So price to earnings ratio, I can see dividend yield is 0. Why would it be 0? They're not paying dividends. No dividends for that company. So could you analyze their dividend decision if they're not paying dividends? So I wouldn't choose that company. If I looked at that and went, oh, they're not paying dividends, that's going to make my life really hard. I'm going to choose a company that is paying dividends, so I've got something to write about. Looking down, I can see things like leverage. So leverage looks at their use of debt. They've even got the debt to equity ratio in here calculated for you. They measure working capital as well, which is a measure of liquidity. So you can get some summary information just by going to this report, and across the top, it goes from June 2015, 16, 17, 2018, 2019, 20, 21, 22, 23. So each year from 2015 to 2023, the details are there. So there's quite a lot of data. I've only asked you to look at the last 5 years. That's one source of data for your assignment. The company website would be another source. The ASX website would be another source. I'm going to close that. I put that down here and said, you can use the database through the library website. It's got some good financial summaries. Go to the company website and have a look at their annual reports and have a look at their press releases. There's other websites like Yahoo Finance and Market Index where you can get information. And on top of that, search online and see what else you can find. You've got keywords to look for. You're looking at risk, you're looking at capital structure, dividend, liquidity. You've got key areas that you're looking at for the company. See what information you can find. So I'll stop there because I think we're about to run out of time. I want you to start thinking about the assignment now, thinking about choosing a company and seeing what information you can research for that company. And then if you start to have some questions, you can ask next week, or you can email me anytime if you've got any questions. But start thinking about your assignment and choosing a company so that you can work on the assignment. So for everyone on Zoom, that's it for this week. I'm going to shut Zoom now. Thank you for joining, and I hope I see you next week.